Hi. Let's learn about understanding default. What happens when you default on a loan? A default is the failure to make required interest or principal repayments on a debt, whether that debt is a loan or a security. This can happen to individuals, businesses, and even countries. Default risk is an important consideration for creditors. A default can occur on both secured and unsecured debt. For example, failing to make timely payments on a mortgage loan secured by a house could result in default, as could not making required coupon payments on corporate bonds. Defaults can also happen on unsecured debt, such as credit card balances, which can reduce the borrower's credit score and limit their future borrowing. The consequences of defaulting on secured and unsecured debt can vary. For secured debt, such as a mortgage, the lender may repossess the collateral, like a home or vehicle, if the borrower defaults. On the other hand, defaulting on unsecured debt, such as credit card balances, can lead to the debt being charged off and eventually sold to a collection agency for recovery. Student loans are an example of unsecured debt. Defaulting on a student loan can negatively impact an individual's credit score and future borrowing opportunities. Those who default on federal student loans may also face wage garnishment. When a payment is 90 days overdue, the loan is considered delinquent and is reported to credit bureaus, affecting the borrower's credit rating and potential future loan opportunities. A loan will end up in default if the payment is at least 270 days late, leading to further consequences, such as withholdings of tax refunds and wage garnishments for federal student loan borrowers. When borrowers realize they may have difficulty making loan payments, they can contact their lender to work out a more attainable repayment plan or obtain deferment or forbearance on their loan payments. As a COVID-19 relief measure, student loan payments and the accumulation of interest on outstanding loans were suspended. However, these measures have since come to a close. Sovereign default occurs when a country doesn't repay its debts. This can result in economic downturns, devaluation of currency, and exclusion from debt markets. Defaulting on a futures contract means failing to fulfill the obligation set forth by the agreement, which can result in collections actions and lawsuits. Puerto Rico's default on bond payments in 2015 and subsequent economic crisis serves as a real-world example of the consequences of defaulting on debt. When you default on a loan, your account is sent to a debt collection agency, reducing your credit score, compromising future borrowing opportunities, leading to charged fees, and possibly resulting in the seizure of your personal property. Defaults stay on a credit report for 7 years, impacting the individual's credit score. However, the default may be removed earlier if it was a mistake. An example of a default would be not paying a credit card bill or a monthly mortgage payment, resulting in missed payments on borrowed money. Defaulting on debt can have lasting consequences for individuals, businesses, or even entire countries. It can affect credit ratings, access to future loans, and lead to the seizure of property or wages. Here are 3 key takeaways. 1. A default occurs when a borrower stops making required payments on a debt. 2. Defaults can occur on secured debt, such as a mortgage loan secured by a house, or on unsecured debt, such as credit cards or a student loan. 3. Defaults expose borrowers to legal claims and may limit their future access to credit opportunities. Hope this would help. Thanks for watching.